If you've worked for 40 or 50 years building your retirement savings, you've probably witnessed a few market downturns. You've seen corrections of 10 or 15%. You might even remember 2008 or 2020, when major recessions wiped out 30 to 40% of portfolios. Those were difficult years, but your portfolio eventually recovered. But there's something on the financial horizon right now that appears less frequently, something that tends to precede far more severe damage. The metric is called the CAPE ratio, and as of January 2026, it has reached a level that historically shows up only before the most brutal market crashes in modern financial history. The CAPE ratio, the Cyclically Adjusted Price-to-Earnings ratio, was invented by Yale economist Robert Shiller specifically to identify when stock markets become dangerously overvalued. Unlike traditional price-to-earnings measurements, which can be distorted by temporary earnings swings during recessions, the CAPE ratio uses 10 years of inflation-adjusted earnings to create a much more stable valuation picture. It answers a simple but critical question: how much are investors paying for each dollar of normalized inflation-adjusted earnings? As of this week in January 2026, the CAPE ratio stands at approximately 39.85 to 40.58, depending on the exact source and timing of measurement. That might sound like a meaningless number to most people, but to financial historians, to pension fund managers, and to anyone who studies market cycles, this number is a red light. It signals something that happens rarely enough to be significant, but frequently enough to establish a pattern. The historical average for the CAPE ratio over the past 150 years is approximately 17. Right now, the U.S. stock market is trading at a 135% premium to that average. Investors are paying $2.35 for every dollar of normalized earnings, when history says they should be paying roughly $1. The last time this happened was January 1999. The time before that was in the late 1920s, in the years immediately preceding the Great Depression. In January 1999, the CAPE ratio exceeded 40 for the first time in recorded financial history. By December 1999, it had peaked at 44.19, the highest level ever recorded. What happened next is important for anyone saving for retirement, because the events that followed offer a clear picture of what historically happens when valuations become this extreme. The markets continued to rise modestly in early 2000. January and February showed strength. But in March 2000, reality finally caught up to expectations. The Nasdaq Composite, which is concentrated in technology stocks, had risen 86% in 1999 alone and had become a launchpad for internet startups that had no earnings, no clear business model, and no path to profitability. As soon as investors realized that growth at any cost was not a sustainable investment thesis, the selling began. In March 2000, the Nasdaq began its decline from its peak of 5,048 points. The decline would last 30 months. What happened during those 30 months is the cautionary tale that retirement savers need to understand. The Nasdaq Composite ultimately fell 76.81% by October 2002. The S&P 500 fell approximately 49%. The Dow Jones fell 27%. These are not mild corrections. These are the kind of declines that wipe out decades of careful saving if they hit during the years when retirees are drawing income from their portfolios. For investors who were already retired in 2000, the damage was particularly severe. A retiree who was drawing 4% annually from $1 million portfolio had planned to receive $40,000 that year, but when the portfolio fell 50%, it was worth only $500,000. If that retiree continued to withdraw $40,000, now 8% of the remaining portfolio, they forced themselves to sell stocks near the bottom of the market to generate that income. This is called sequence of returns risk, and it's one of the most dangerous threats to retirement security. Consider the practical impact. If you were retired in 2000 with $1 million portfolio and you drew from it during the subsequent bear market years, your portfolio in 2002 might have been depleted to $400,000 or less. Even if you had perfect discipline and stopped drawing during the worst years, waiting until 2003 to resume, that forced period of non-income would devastate retirement plans that counted on steady payouts. The recovery, when it came, was slow. The S&P 500 didn't return to its 2000 peak until 2007. That means investors who experienced the 2000-2002 crash had to wait approximately 7 years just to break even. For a retiree in their 70s, 7 years is a significant portion of their remaining life expectancy. Now let's examine what happened the second time the CAPE ratio approached these extreme levels. In the late 2000s, a different bubble had formed. This time it wasn't technology stocks that were overvalued, it was housing. Subprime mortgages had become fashionable. Lenders were issuing mortgages to borrowers with poor credit, little down payment, and adjustable rates that reset to higher payments after a few years. The financial system had built enormous leverage on top of this shaky foundation. By May 2007, the CAPE ratio had peaked at 27.6, which, while elevated, was considerably lower than the 40-plus levels seen in 2000. However, the underlying valuation metrics were similarly distorted. Companies reported earnings using accounting methods that masked the fragility beneath. Banks were holding mortgage-backed securities that they believed were safer than they actually were. The system was over-levered and over-leveraged. When the housing market began to crack in 2007, the consequences cascaded through the entire financial system. Bear Stearns, a major investment bank that had survived the Great Depression, Watergate, and every market crisis in between, collapsed in March 2008. Lehman Brothers declared bankruptcy in September 2008. Washington Mutual, which had been the largest S&L in the United States, failed. AIG required a government bailout. The financial system itself teetered on the edge of collapse. The stock market response was immediate and brutal. From its October 2007 peak to its March 2009 bottom, the S&P 500 fell 56.4%. The S&P 500 didn't recover to its 2007 peak until 2013, a full 5 years later. For retirees drawing from portfolios during this period, the impact was devastating. What's particularly important about both of these episodes, 2000 and 2007, is that they didn't happen at the peak of the CAPE ratio. They happened as the ratio was declining from extreme levels. The 2000 crash didn't begin immediately after the January peak. It began months later after investors held hope that valuations might expand further. The 2007 crash didn't begin as the housing market peaked. It began as the cracks were becoming visible. This pattern matters enormously for retirement planning because it means the most dangerous period is not necessarily the moment when valuations hit extremes, it's the months that follow when investors gradually realize that further expansion is impossible and when the mechanical work of repricing begins in earnest. Fast forward to today. As of January 2026, the CAPE ratio has climbed back above 40. The only other time in 155 years of recorded data that this has occurred was in 1999. And while the narrative is different this time, it's artificial intelligence rather than dot-com internet startups, the core dynamic is identical. Investors are paying more than twice the historical average price for each dollar of normalized earnings. The stock market is pricing in decades of perfect execution and consistent growth from companies that face increasing competition, slowing growth rates, and mounting challenges. The crucial question for someone in retirement or approaching retirement is this: what happens now? History offers two possible paths. The first path is that valuations expand even further and the market continues to rise. This is possible. Markets have surprised investors before. But consider the mathematical constraint. If the CAPE ratio were to expand from 40 to 50, it would require stock prices to rise 25% while earnings remain flat, or an equivalent combination of price and earnings growth. This is theoretically possible, but historically rare at valuations this extreme. The second path, which historical precedent suggests is more likely, is that the CAPE ratio reverts toward its long-term mean. The mean is approximately 17. If the ratio reverts to mean from 40 to 17, it implies a 57.5% decline in stock prices, assuming no earnings growth. If earnings decline during the reversion, which happened in both 2000 and 2007, the combined impact is even more severe. Neither outcome is inevitable. Markets are not mechanical. They're driven by sentiment, expectations, policy responses, and sometimes genuine surprises that shift the fundamental outlook. But when valuations become this extreme, the probability of a material correction increases significantly. And for a retiree, a material correction at the wrong time in the market cycle can mean the difference between a secure retirement and financial hardship. One additional parallel between 1999 and 2026 deserves attention. In both periods, the extreme valuations were concentrated in a subset of the market. In 1999, the concentration was in technology stocks, particularly internet startups. In 2026, the concentration is in the Magnificent Seven: Apple, Microsoft, Alphabet, Amazon, Meta, Nvidia, and Tesla, which now represent 35 to 40% of the entire S&P 500. This concentration is extraordinarily high. During the dot-com era, the most concentrated sectors never exceeded the equivalent level of index representation. This concentration creates a specific risk for retirement portfolios. If you own a simple S&P 500 index fund, you are automatically 35 to 40% concentrated in these 7 companies. A 50% decline in the Magnificent Seven would translate to a 17.5 to 20% decline in your overall index fund, even if the rest of the market remains stable. But historically, during severe corrections, the entire market experiences stress, not just the overvalued sectors, so the combined decline could easily exceed 30 to 40%. For a retiree drawing 4% annually, a 40% portfolio decline is deeply problematic. It forces a sequence of returns issue that can exhaust savings years ahead of schedule. For someone in their early 60s approaching retirement, a 40 to 60% decline in the next few years fundamentally changes the retirement timeline. Projects that seemed affordable at age 62 suddenly become unaffordable at age 65 after a major portfolio decline. What does the historical record suggest about the timing of a potential correction? The answer is murky. The 2000 crash didn't happen immediately after the CAPE ratio peaked in late 1999. It took months for reality to catch up to expectations. Similarly, the 2008 crisis built for months before the acute panic phase. There's no precise timing mechanism that says, when CAPE reaches 40, expect a 50% crash within 6 months. The relationship is probabilistic, not predictive. However, what the historical record does show clearly is this. When CAPE ratios reach 40 or above, subsequent 10-year returns are historically very poor. According to research by Deutsche Bank analyzing 25-year return histories, markets purchased at CAPE ratios below 8x have delivered approximately 10% annual returns. Markets purchased at CAPE ratios above 20x have delivered approximately 4% annual returns. At a CAPE of 40, implied future returns are essentially 0 to negative, depending on the exact reversion path. For someone in retirement, this matters enormously. If you're planning for 7% returns to sustain your portfolio, but the market is likely to deliver negative returns for the next decade, your retirement math breaks down completely. You'll outlive your money, you'll be forced to cut spending, you'll become dependent on family members or government assistance. This is why the CAPE ratio reaching 40 is not academic. It's a practical warning about the years ahead. The question every retiree or pre-retiree should be asking themselves is this: can my retirement plan survive a 50% decline in my portfolio in the next 2 to 3 years? If the answer is no, then something needs to change in your portfolio allocation, your withdrawal rate, or your retirement timing. One further consideration, the Federal Reserve's policy response will matter enormously. In 2000, the Fed cut interest rates aggressively to try to revive the economy. Those rate cuts eventually enabled a recovery. In 2008, the Fed did the same, but more so, creating quantitative easing and near-zero interest rates that eventually revived markets. Today, interest rates are already relatively low, and the Fed has limited room to cut further. This constraint could mean that any correction takes longer to recover from because the policy support mechanism that previously worked may be less available. Financial advisors are beginning to notice the elevated valuation levels and are adjusting client portfolios accordingly. The shift is toward broader diversification, away from concentration in the mega-cap growth stocks. They're recommending additions to dividend-paying stocks, international holdings, and asset classes that have lower valuations. They're recommending rebalancing from winners to losers, the classic investment discipline of buy low, sell high. For someone in retirement, a prudent response involves several concrete steps. First, audit your portfolio concentration. How much are you actually exposed to the Magnificent Seven, either directly or through index funds? If that exposure exceeds 40% of your portfolio, you have more concentration risk than historical prudence would suggest. Second, reassess your withdrawal rate. If you're withdrawing 4% and your portfolio is likely to deliver near zero returns for the next decade, your math doesn't work. Consider reducing your withdrawal rate to 3% or lower, or delay retirement if you haven't retired yet. Third, ensure you have adequate liquid reserves outside the stock market. If a major decline occurs, you want to be able to draw living expenses from cash or bonds rather than being forced to sell stocks near market bottoms. Fourth, consider your age and time horizon. If you're 60 and plan to live to 95, you have 35 years to recover from a market decline. That's sufficient time that a 50% decline, while painful, is probably survivable if your withdrawal rate and diversification are managed prudently. But if you're 75 and plan to live to 95, you have only 20 years to recover. That's tight. And if a major decline happens in the next 2 to 3 years, your recovery window is compressed further. At age 75 with a 20-year horizon, you may not have time to recover from a 50% market decline if you're drawing from the portfolio simultaneously. The CAPE ratio reaching 40 isn't a prediction, it's a signal. It's a historical marker that shows up before the most severe market crises. The last 2 times it appeared at this level, the market experienced 70% to 76% declines in the most concentrated sectors and 40 to 57% declines in the broader index. The path to those declines took time, months to years, but the end point, when reached, caused lasting damage to portfolios that weren't positioned defensively. Your retirement security depends on your portfolio surviving not the average year but the difficult years, It depends on making it through extended periods of portfolio decline without being forced to sell at losses, and it depends on having realistic expectations about future returns given current valuations. When valuations are at 40-year extremes, realistic expectations mean returns that are below historical averages and portfolio declines that may exceed anything you've experienced in your working career. The signal is clear. The historical precedent is undeniable. The question now is whether you'll let that signal inform your retirement planning, or whether you'll assume this time is different, that valuations don't matter, that corrections don't happen to you, that your portfolio is somehow immune to the forces that have humbled investors for 150 years.